Welcome to our deep dive into global macro trends and how they shape the stock market in 2025. Today, we'll explore the forces driving economies and markets worldwide. From trade policies to inflation, every trend matters for investors. Let's start with the big picture. The global economy in 2025. The world economy is expected to grow at a modest pace of about 3%. This is slightly down from 2024, reflecting new challenges on the horizon. The United States remains a key driver, but policies are shifting fast. New trade tariffs are creating ripples across global markets. These tariffs, especially from the US, target major trading partners. Countries like China, Canada, and Mexico are feeling the heat. In April 2025, tariffs on Chinese goods hit as high as 125%. This sparked volatility, with markets dropping sharply at first. The S&P 500 fell over 10% in just 2 days. That's a scale of decline not seen since the 2020 crisis. But then, a 90-day tariff pause was announced for some countries. Stocks rebounded, with the S&P 500 gaining nearly 6% in a week. This shows how sensitive markets are to policy changes. Tariffs raise costs for companies, especially in tech and manufacturing. Higher costs can squeeze profits, which worries investors. For example, Apple and Nvidia saw 5% drops in early 2025. But not all sectors suffer equally under tariffs. Utilities and consumer staples held up better. These defensive sectors often weather economic storms. Now let's talk about inflation, another major trend. Inflation is proving stubborn in 2025. In the US, consumer prices are expected to rise by 2.6%. That's higher than the Federal Reserve's 2% target. Tariffs are partly to blame, as they push up import prices. This makes goods like electronics and clothing more expensive. Higher inflation also affects how the Federal Reserve acts. The Fed cut rates by 1% in late 2024, but in 2025 it's scaling back on further cuts. Analysts now expect just 2 rate cuts this year. Higher interest rates make borrowing costlier for companies. This can slow down expansion and hit stock prices. Small-cap stocks, like those in the Russell 2000, are especially vulnerable. The Russell 2000 dropped over 20% early this year. That's officially a bear market for smaller companies. On the flip side, lower rates could boost growth stocks. Tech giants like Microsoft might benefit if rates ease. But for now, the Fed is cautious, watching inflation closely. Let's shift to another trend. Artificial intelligence. AI is transforming industries and driving market gains. In 2024, AI-related stocks soared, led by companies like Nvidia. This trend is continuing into 2025, but with some caveats. Investors are now questioning if AI valuations are too high. Some worry it's a bubble like the dot-com era. Still, AI adoption is boosting productivity across sectors. Software and healthcare firms are investing heavily in AI. This could lead to long-term gains for diversified portfolios, but short-term volatility remains a risk for tech stocks. Next, let's look at geopolitical risks. Tensions between major powers are shaping markets. The US-China trade war is escalating again. China retaliated with tariffs up to 125% on US goods. This tit-for-tat is hitting global supply chains. Companies reliant on Asian manufacturing are struggling. The Nasdaq, heavy with tech, lost 17% from its peak. Meanwhile, safe haven assets like gold are surging. Gold prices broke past $3,200 an ounce. Investors are flocking to it amid uncertainty. Geopolitical risks also affect energy markets. Oil prices are volatile due to Middle East tensions. This impacts energy stocks both positively and negatively. Energy firms like ExxonMobil see gains when prices spike, but airlines like Delta face higher fuel costs. Delta cut its profit forecast by half in early 2025. This shows how interconnected global trends are. Now let's explore consumer sentiment. In the US, confidence is dropping fast. The University of Michigan's Consumer Sentiment Index fell 11% in March. That's 27% below last year's level. Worries about tariffs and inflation are weighing on people. If consumers spend less, retail stocks could suffer. Companies like Walmart and Target are at risk, but some sectors like discount retailers might benefit. Dollar General could see gains as budgets tighten. This shift shows how markets adapt to economic signals. Another trend to watch is currency movements. The US dollar is strengthening in 2025. This is driven by higher interest rates and trade policies. A stronger dollar hurts US exporters. Their goods become pricier for foreign buyers. Companies like Boeing and Caterpillar could face headwinds. But it helps importers like retailers buying overseas goods. The euro, meanwhile, is weakening against the dollar. Some predict it could hit parity by year-end. This makes European stocks more attractive to US investors. But it also raises costs for European importers. Currency shifts are a double-edged sword for markets. Let's move to emerging markets now. These economies face unique challenges in 2025. Growth is slowing, projected at 3.4%. That's down from 4.1% in 2024. US tariffs are hitting their export-driven economies. China, a major player, is battling deflation. Its GDP growth may dip to 5.1%. Chinese stocks, like the CSI 300, fell nearly 3% in a week. But stimulus hopes are keeping declines in check. India, on the other hand, is showing resilience. Its service sector is driving economic growth. Indian stocks could outperform other emerging markets. Still, emerging market currencies are volatile. They're losing ground against the strong dollar. This makes investing in these markets riskier. But for those with high risk tolerance, there's potential. Now let's talk about Europe's outlook. The Eurozone is expected to grow at just 1%. Trade disruptions are a big drag on the region. But some countries, like Germany, might see a boost. US tariffs could push manufacturing back to Europe. Small and mid-cap European stocks could benefit. The DAX index may outperform larger global indices. Still, inflation in Europe is steady at 2.3%. The European Central Bank is easing rates slowly. This supports stocks but limits big rallies. Japan is another interesting case. It's moving away from decades of deflation. Inflation is now stable around 2%. The Bank of Japan is raising rates to a 30-year high. This strengthens the yen, which hit 142 against the dollar. Japanese stocks could see steady gains, but exporters may struggle with a stronger currency. Companies like Toyota could face profit pressure. Let's zoom out to portfolio strategies. Diversification is key in this uncertain environment. A mix of US, European, and emerging market stocks can balance risks. Value stocks are trading at a discount. They're down 22% from fair value in some cases. Sectors like financials and healthcare look promising. They often thrive in volatile markets. Bonds are another option to consider. Treasuries are outperforming riskier corporate bonds. Yields on 10-year treasuries are around 4.2%. This offers a safe return amid stock market swings. High-yield bonds, however, are under pressure. Trade wars could hurt corporate earnings. This raises default risks for weaker companies. Investors are shifting toward quality and stability. Stocks with strong balance sheets are in demand. Look for companies with low debt and steady cash flow. These traits help weather economic storms. Another factor is corporate earnings. Earnings growth is slowing in 2025. Analysts expect S&P 500 earnings to rise by 10%. That's down from 12% in 2024. Tariffs and higher costs are squeezing margin. Tech firms are still leading, but growth is uneven. Smaller companies are struggling to keep up. This creates opportunities for active investors. Picking undervalued stocks could yield big returns, but it requires careful research and timing. Market volatility is another trend to watch. The VIX index, a measure of fear, hit 45 in April. That's the highest since the 2020 pandemic. Sudden policy changes are driving these spikes. Investors need to stay nimble in this environment. Hedging with options or gold can reduce risks. But don't try to time the market perfectly. Long-term investing usually beats short-term bets. Let's talk about sustainability trends. Green energy is gaining traction globally, but policy shifts are creating uncertainty. Some US policies may slow the green transition. This could hurt renewable energy stock. Companies like First Solar may face challenges, But global demand for clean energy remains strong. Europe and China are doubling down on renewables. This creates opportunities for international firms. Investors should look at diversified energy portfolios. Mixing traditional and green energy can balance risks. Now let's discuss fiscal policy. U.S. deficits are projected at $1.9 trillion. That's 6.2% of GDP. High deficits could push bond yields higher. This makes stocks less attractive than bonds, but tax cuts could stimulate growth. They might boost corporate profits short-term. Cyclical sectors like financials could benefit, but long-term deficits raise inflation risks. This keeps the Fed on high alert. Let's look at labor markets. U.S. unemployment is ticking up slightly. It's expected to hit 4.2% by year-end. This could slow consumer spending. Retail and hospitality stocks may take a hit, but tech and healthcare are less affected. These sectors rely less on discretionary spending. Global labor trends vary widely. In the UK, labor shortages are pushing wages up. This fuels inflation, limiting rate cuts. UK stocks may face pressure as costs rise. In contrast, Japan's labor market is tightening. Wages are rising, supporting consumer spending. This could lift retail and service stocks. Let's explore sector-specific trends. Technology remains a market leader, but valuations are stretched, raising risks. The Magnificent Seven tech stocks gained 47% last year. Compare that to just 10% for the average S&P 500 stock. This gap shows how concentrated gains are. If tech falters, markets could see big swings. Financials are another sector to watch. Higher interest rates boost bank profits. JP Morgan and Goldman Sachs could see gains, but a slowing economy might increase loan defaults. This creates a mixed outlook for the sector. Healthcare is showing resilience. Demand for services is steady, even in tough times. Companies like United Health are holding strong. Mergers and acquisitions are also picking up. This could lift healthcare and financial stocks, but regulatory risks remain a concern. Let's wrap up with long-term trends. Aging populations are reshaping economies. In Japan, over 40% are over 65. This boosts healthcare and pension costs. It also slows GDP growth in some countries. Investing in healthcare and robotics could pay off. Automation is another long-term driver. It's transforming manufacturing and services. Companies like Siemens and Fanuc are leaders here. These trends suggest steady growth over decades, but short-term bumps will test investor patience. So, what's the takeaway for 2025? Markets are navigating a complex landscape. Tariffs, inflation, and geopolitics are driving volatility, but opportunities exist for those who adapt. Focus on diversification and quality stocks. Stay informed and don't chase short-term trends. That's all for today's deep dive. Thanks for joining us, and happy investing.